And 2011 could be an even better year for M&A, according to the pair we're about to hear from. Bob Profusek is head of M&A over at Jones Day, which Bloomberg ranks as the #1 law firm for deals through the third quarter of this year. He's been working in the field since 1975 and represented Potash in the recent failed acquisition by BHP Billiton. Also back with us, Nancy Havens-Hasty, president of Havens Advisors. That's an investment firm focusing on M&A arbitrage and distressed securities investing. So great to have you both here with us.
Nice to be here.
So it sounded like from the package that we expect the M&A activity to continue next year. Bob, do you agree? Are you busy right now?
Yeah, we're really busy. Lawyers are kind of always busy, I suppose. There's good environments and bad. The macro environment is very good. Oodles of cash, debt financing is great. You've got the geopolitical and economic changes. You've got everything. I mean, it's sort of a deal maker's dream. But there is one thing, which is we went through the financial crisis. And
that's still out there, isn't it?
Yeah, it's still out there. And the one thing I would disagree about a little bit on the clip we just saw is that the sort of suggestion that CEOs are confident and boards are ready to rock and roll. I'm not so sure. The macro environment was perfect in 2010. Yeah, we had the blip with the Euro debt crisis actually a couple of times. But there's tons of cash, all the same factors applied. And while it's been a good year,
right,
it hasn't been a barn burner.
Well, that's a good point. I mean, Nancy, obviously CEOs are not confident enough to get out there and aggressively hire. So there's something holding them back. I mean, are you seeing that in terms of the work you're working on?
Yes, absolutely. I think the reason why mergers are so popular right now is, #1, there's a lot of cash on the balance sheets, as Bob mentioned. The corporate balance sheets at the end of the third quarter had 7.9% cash, which is the highest percentage of assets since 1958 or something in the late 50s. So there's an enormous amount of cash earning virtually no money. And you have a lot of corporate confidence, but not so much consumer confidence. So CEOs are still in a situation where they're a little bit hesitant to really make the big bets, like building a new factory where they have to get new sales. And instead they can make these much lower risk bets, which are mostly smaller acquisitions, tuck-in acquisitions, and very specific products, expanding very specific product lines that are quite low risk because they already have the revenues. And they can probably even reduce costs further by combining and realizing synergies.
You know, we mentioned, Bob, that Intel and Caterpillar, I mean, they did some big deals, or Caterpillar did specifically. I mean, do you expect it's just more small deals in 2011? That's what we see, strategic deals?
Well, I think we're going to see strategic deals. There'll be plenty of, we've sort of gotten jaded about big. A $5 billion deal is still a pretty big deal.
Well, when you go back a couple of years, right?
Well, there's not that sort of, ebullient, sky's the limit mentality. And you're right, it's the buy and build paradigm is always the problem. That's why M&A is here. It's because you know what you're getting. You don't have to guess about, greenfielding and all the rest of it. And so it's always a sort of a lower risk proposition to buy than to build. That's a problem for the economy globally, I suppose. And there's another thing, even with the big deals. I mean, one of the most interesting deals to me last year was Exxon XTO. Exxon's Exxon, after all. And this was a big deal, $35 billion or so, but their stock got hammered when they did that. This is Exxon. And yet you see what HP and Dell did bidding up against 3PAR, where it was $2 billion.
Right.
But it got washed out in their numbers. It wasn't big enough to move the needle. So they could do a strategic deal and really bid it 300% up from the initial bid. And nobody complained about that. So I think there's going to be a just general reluctance to pull the giant trigger. I think people are going to be hitting to get on base rather than to hit grand slam.
What could change that? I mean, is it greater confidence? But we're not going to get that necessarily.
No, we probably won't. I mean, the big mega deals are always at the very end of the big bull cycle. And we're obviously not at the end of a big bull cycle. We're barely at the beginning of a market cycle. So you're not going to see the big, huge sort of game-changing deals because people aren't willing to risk that right now. They've just been chastened by the worst, economic situation since the Depression.
Right. I mean, but the amount of activity, most of the activity is still happening in North America.
That's right.
I mean, that's the engine of growth for M&A.
Right, but Europe has woken up. And we have a lot more European activity now than we had even a few months ago.
Right.
There's a huge change in Europe. And also, we have the Chinese and the Brazilians doing deals everywhere.
Well, and that's what I say, the role of Asia. I mean, Bob, what do you see the role of Asia specifically, China specifically?
Well, you're going to see a lot of activity. It's hard. It's still very difficult to get into China. There's just no question about it. We can pretend it's not, but it's a communist country, and it is what it is.
Right.
And those deals are typically very small, and sometimes even strategic deals, like the Charles River deal this summer, which was a very strategic deal, and their shareholders, Charles River shareholders, said no. Now, it was led by a hedge fund that sort of coalesced people around that, but there's tons of money, and it's going to be deployed, and it's going to be deployed through companies, the sovereign wealth funds in Asia, their factors. We worked on the potash defense. Obviously, everybody in that neck of the woods was interested in that situation. So there's plenty of money. Now, there may be one area in which we will be seeing big deals, and those are more in the combination side, not the takeover side, where Continental and United Air merge because of all the strategic benefits for that MOE. So I think we're going to see a fair bit more of that, in part because they're going to be enabled by the credit markets,
which have been very conducive
and in part because we've got lots of industries that still have overcapacity, and the logical way to deal with that is to combine.
So I want to look forward again to 2011, and Bob, talk to me about where you think the deals are going to get done. We were talking in the break about commodities. I mean, that's a really hot area, continues to be.
Yeah, and commodities are going to be very hot. I was kiddingly saying anything you can buy a future about, buy the company that's involved in that business right now.
There's really that much activity.
Yeah, there's going to be a lot, and obviously a lot of cross-border money, and mining, minerals, oil, gas, you name it. There's going to be activity in that space. But it's almost easier to pick the industries that aren't likely to be active. I mean, tech was very active this year. Believe it or not, real estate was very active. It's going to be very active in 2011. We saw a lot. We're going to see a lot in the consumer space. You're going to see a lot of PE money, and we have seen some going into retail and all the rest of it.
And that's finally coming back, private equity money.
Yeah. And I think the private equity firms are a little bit like the CEOs we talked about in the last segment. Everybody says, well, their commitments are going to burn off in 2011, so they're going to spend. They're not like that. I mean, these are not little buyout shops anymore. They're institutions, and they're not going to do deals after what we've been through that they're not comfortable with.
Right.
So
and necessarily get stuck with something they don't want.
I think there are a couple industries that have been tough. Healthcare has been tough in a broad sense. There have been. We were talking about it. There have been
farmers. You say tough, but Nancy, you think there's going to be healthcare.
Different kind of healthcare. I think he's talking more hospitals and stuff like that. I'm talking pharma, biotech. There have been a lot of pharma, biotech deals because the pharmas have so much money and so many product expirations. And the biotechs, especially in beginning of 2009, had no money and no access to money and needed money to keep their research going.
But there's more room for consolidation because there has been a fair amount already.
Yes, there's been a fair amount, and it's going to continue. I think in the biotech pharma side. The healthcare hospitals, that's a little more difficult, I think. But it'll happen too, I think.
So most areas you guys see activity.
Yeah, I do think that we're going to be led. My personal view is we're definitely going to be led by energy and minerals, mining, and all the rest of it. I think there's going to continue to be, as it was this year, a ton of tech stuff. And I actually think real estate is going to be very active this year. And then everything else is going to be everything else. But it's a great market, and we're going to see lots of activity. I think through November we're at 2.15 or something trillion. That compares to $4 trillion in 2006. So even though it's a good year, it isn't a blowout year yet. Could it be over 3 next year? I think easily.
Well, that's great perspective, Nancy. I've got a few seconds left here. I mean, do we get back to those pre-recession, pre-crisis levels anytime soon, just quickly?
I don't think soon. I think yes, because everything happens in cycles, and it's going to happen again. But I think it's going to be at least 5 years from the last, say, from 2008. So 2013, 2014.
It's a while.
A while,
yes. You agree? I got 5 seconds here.
I think so.
It's a while.
Yeah, it's a while.
All right, we leave there. Bob, Nancy, thank you so much.
Thank you.
Really appreciate it.